Hey, how you doing? Map here, Map Investments. Want to talk to you today about Shift Technologies. Did a trade in there today, and seems like it's a popular stock uh, nowadays. Today was down 39 cents on light volume. Let me pull up the Market Smith chart here. So this stock just came out and it's been all over the place from 15 down to over here to the low six, and it's all over the place. So it's really no pattern or anything, but it's on the lower end. So and the options are very expensive. These guys, they provide automotive e-commerce platform for buying and selling used cars, basically like Carvana. So here's their website. They have Cyber Monday deals. Wow. So um, yeah, they're like Carvana. They're up and coming. I think they're like what 500, $704 million company. So the trade I did in here today um, in Shift. Let me see. Hopefully my computer don't freeze. Okay, here we go. Shift. Okay, so the implied volatility is 130. 130% is very high. Um, don't have an IV rank. Remember, IV rank is calculated on the yearly basis on the implied volatility for a year. That's how it's calculated. Had 3,800 calls, not many puts. But remember, I'm not a options buyer. I'm a net seller of options. So you know, the typical person will come, oh yeah, I want to buy Shift. I want to get into Shift. You could buy 100 shares, $874 if you wanted to get into it, or you can buy a call. Oh, I want to buy a call, but these calls are extremely expensive. The $10 call is $115. That means that the break even on this stock is 11.15. You buy the option. This option was down 35 cents today. So you buy this option for 115 and you add it to the strike price of 10, and that's usually your break even. It'll be 11.15, give or take time decay. Now this contract, which is here are the four Greeks: delta, gamma, theta, vega. I only really associate myself with delta and theta. Gamma and vega are volatility Greeks. You can look them up. You can look up each of them and learn if you want. Um, I can explain to you what theta is, which is what I look at. Theta is how much remember options decay. They are decaying assets. That's why you don't want to buy them. You want to be a net seller of them and collect good premiums when the volatility is high. So delta is what it decays daily, and I'll show you that number now. It's 2 cents a day. So by Monday, this option will decay at least 10 cents. Okay, and delta is basically how many shares you own. So if you buy this option, you're buying a 47 delta. Remember, one contract is 100 shares, so you're basically buying 47 shares of an out of the money option. If you buy 100 shares of this stock, it's 100 deltas. So I hope you understand. So if you buy 47, you have 47 shares of this stock. So what I did today was, since I don't buy options, I went to the other side. There was less liquidity. There wasn't a lot of action on this side compared to this side. But what I did was I sold the 10 and I bought the 750. And I did this for a net credit of $1.40. So what is my goal? My goal is now to buy back this spread for $70 in the next 21 days. And I do this over and over and over again. I hit singles and doubles, singles and doubles. Today I did 75 trades. That's what I did today, 75 trades. So I hope this video, right now I'm down $22, and it only takes $250 of capital to do this trade. So I hope you find this video informative. Like it, share it, subscribe, and have a good night. I'm going to do a couple of videos because the ones I did before didn't have volume, unfortunately. Have a good night. Bye-bye.